Hi folks, can you hear me?
Yeah. Yep. Yep.
Looks like most of you took the quiz. It looks like most of you did well. It's amazing how quickly you get feedback from a computer, right? Did it actually give you the score right after you finished the quiz, or did you have to go to NYU classes to check?
Didn't give us the quick score yet. We don't get it like tomorrow.
Oh, you don't get it till tomorrow. Maybe I'll set it to 9 a.m. tomorrow so you can go see it. So it'll be on NYU classes and you get the whole thing. Right. It's in the grade book, that's right. Anshu has checked and a couple of you have checked. It's already in the grade book. Don't go now. Come on. You can wait till after the class is over. It's only 45 minutes today. And she says, I'm in a great mood today. I'm always in a great mood. Am I ever in a bad mood? I don't think so. You know why I'm in a good mood? Because most of you did well. I always feel badly when people do badly on my quizzes. So I'm happy that most of you had a easy time. I was worried about, about this being an online quiz and how it would work out. But hey, so far so good. Okay, we'll give it one more minute, then we'll get started. Okay, so I'm going to get started. Last session before the quiz, so we'll talk pre-quiz, post-quiz. Pre-quiz, we just got started on valuing emerging market companies as part of the dark side. And the first thing I said with emerging market companies, be careful about country risk. Use it as a scalpel, not as a bludgeon. And what I meant by that is don't take every Brazilian company and punish it for being Brazilian, every Indian company and punish it for being Indian, because you can have 5 Indian companies which have very different exposures to Indian country risk. In fact, later in this session, I'm going to show you valuations I did of 4 Tata companies: Tata Chemicals, Tata Motors, Tata Steel, and Tata Consulting Services. All 4 Indian companies with very different exposures to Indian country risk. Now, there are 2 ways you can bring in these differences. One is through the land approach, but it's a little long drawn out, difficult to do. The other is by using a weighted average equity risk premium. So I was showing you my valuation of Embraer, a Brazilian company that gets only about 5-6% of its revenues in Brazil, gets most of its revenues outside, and how it's less exposed to Brazilian country risk than the typical Brazilian company. So that was my first stop with emerging market companies. Are there any questions on that issue? So basically, it's a country risk issue and how you bring it into the valuation. Okay. Question? So let's talk about currency. By now you already have heard my message. Currency by itself is a measurement mechanism. It can't make a bad company into a good company, a valuable company into a valueless company. But the key is to be consistent. Consistent in what sense? Well, every currency brings with it expected inflation assumptions. So if you pick a high inflation currency, your discount rate will be higher. Valuing a company in Turkish lira, you will always have a higher discount rate than if you value it in euros. That's the bad news. The good news is when you value a company in Turkish lira, you can give it a much higher growth rate, because the same inflation that pushes up your discount rate also pushes up your growth rate. And this is particularly relevant to today's day and age because you know what's happened to the T-bond rate. It's dropped to 0.85%. And if you're doing your valuation in euros, that number was already negative. Pre-crisis, it might get even more negative. And the question is, what do you do? My advice is don't do anything. There's nothing you need to do. So I have a valuation here of Heineken, September of 2019 in euros. Why did I pick Heineken to value? Partly because the risk-free rate is a negative number, minus 0.5%. Here's how it plays out. That low risk-free rate gives me a low cost to capital, 5.04%. But that same risk-free rate also means that when I get to stable growth, I cap the growth rate at minus 0.5%. I'll wager if I showed this valuation to Heineken managers, they could look at that stable growth rate and complain. How come you're giving me a negative growth rate? Hey, I gave you a negative risk-free rate that pushed down your cost of capital. Consistency requires that you keep the growth rate low as well. So when you value a company in US dollars now, it's true. The T-bond rate you're using today is about half what you'd have been using 6 weeks ago. That's the good news for your cost of capital. Your cost of capital will be lower. But at the same time, your growth rate in perpetuity is also going to be lower. And I'll wager that in this case, the effect is negative. You're getting a lower value for your company because that low risk-free rate is transmitting a message about future growth rate. So if the rest of the valuation of Heineken looks very much like the value of any company. I wanted to just focus in on if I pick a negative risk-free rate currency, what happens? What happens is I have a low discount rate, but I also have a low growth rate in perpetuity. Any questions on this point or anything to do with low risk-free rates, negative risk-free rates, many of you might be facing in your valuations? No questions? Okay, so let's keep moving to the corporate governance issue. Now, the reality is when you invest in an Asian company, a Latin American company, and many European companies, Warren Buffett once described when you buy, the way he thought about buying shares is he said, I'm not buying shares in a company, I'm becoming part owner of this company. And technically as shareholders, you're part owners of a company. But the reality is in much of the world, including the US, you own shares in a company, you get very little say in how the company is run because the corporate governance sticks. So when you value Asian or Latin American or European companies where the corporate governance is really weak, or even US companies where the corporate governance is really weak, either because they're voting and non-voting shares or because of some structural problem, many people use it as an argument for discounting the value. They say, look, because the governance is weak, I should be discounting the value of these companies. So I'm going to start with the question. If you had a company where you felt corporate governance was weak and you've done a discounted cash flow valuation of the company, should you discount that value that you get for the absence of power in this company or weak corporate governance? What do you think? Anybody? Let's say you're valuing a family group company, you feel you have very little power in this company, you have weak corporate governance. Should you be discounting the value that you get for the absence of power? Go ahead, Chen. What do you think?
I think probably not because it doesn't directly relate to your fundamentals.
Now, that's a very dangerous statement to make because then you say corporate governance doesn't matter. It does affect
it should be somehow incorporated.
Exactly. You estimated the cash flows for this company, right? So if it's badly managed and badly run, what did you do? You estimated a low return on capital, low margins, low growth, and you valued the company, right? And if it's got terrible corporate governance, you can leave those numbers unchanged because usually with companies, you improve things over time. You say, well, the managers are going to learn, they're going to do the right thing. But if corporate governance is weak, you've left these numbers as bad numbers, essentially in perpetuity. Your value already reflects poor corporate governance. You don't have to discount it more because that would be double punishing the company. But to do this, you have to do your DCF right. When you do your discounted cash flow valuation, and you ask yourself, what will happen to my company over time? When making your assumptions, you have to incorporate who runs the company and the fact that you have very little power to change the company. So you're right. But you're right, only so far as your cash flows already affect. So it's not that it doesn't affect value. It has affected value already. Your value is already low for it. You don't want to discount it further. Yeah? And that's why you have to bring in corporate governance when you do pricing. Because when you price a company, looking at how other companies are priced, you might have to discount the pricing because they haven't had a chance to do this. But if you do a DCF, it should already be in there. Any other comments, questions? Okay. So let me take you through an example of how corporate governance plays out. So this is actually a company in a city that I grew up in India called Chennai. It's called Tube Investments. It's been around a while. And this was about a long time ago, 15, 20 years ago. I value the company for its management. Now, Tube Investments is part of a family group of companies. The family controls the companies. It basically runs the companies. These are publicly traded companies. And the reason they asked me to come in and value the companies, they felt the market was being unfair to them. It was pricing them at like 4 times earnings, and they felt that it was unfair. And they said, can you come in and value the companies? Because we're convinced we're being underpriced, that the price is too low, it should go up. So I came in and valued the companies, and they were a little disappointed in my valuation. Because I sat down and here's what I saw in the company. First, was the company was reinvesting a lot, 113% reinvestment rate. Normally, when you reinvest a lot, you say that's good, they're going to grow fast. They were reinvesting a lot, but even if you allow for the jumps up and down, their reinvestment rate on average over the previous 5 years had been about 60%. So I use that reinvestment rate. Their return on capital in Indian rupee terms then was about 9.2%. Now this was when the rupee risk-free rate was 12% and the rupee cost of capital they were facing was 17%. Now think about the story I'm telling about this company. This company is reinvesting a lot, it's growing, but it's growing by taking projects that earn a return on capital well below the cost of capital. So what kind of growth is this? If you think about value destroying, value increasing growth, this is the definition of value destroying growth. You're saying, why would they keep doing it? They didn't even seem to be aware of the fact that it was value destroying. They said, we're making money, and technically they are, right? A return on capital of 9.2% means you're making money. So they didn't see a problem. So since they didn't see a problem, they didn't see a need to fix the problem. So here's what I did in my initial valuation. Since they didn't see this as a problem, I assumed they would keep earning 9.2% on their projects forever. And I valued the company on the assumption that they would keep growing at 5% a year in perpetuity beyond year 5. Now 5% sounds high, but remember I'm doing everything in rupee terms, so 5% is a pretty reasonable growth rate. I used that growth rate and I came up with a value of about 19.6 billion rupees. I added cash, subtracted out debt, and I came up with a value per share of about 62 rupees per share. You know what? The stock was trading at about 80, I can't see the price, but it's about 102 rupees. So I presented the valuation. They were shocked. They were expecting me to tell them that they were over 200 rupees and the market was wrong. And I said, no, market's actually, I think, being generous to you. You should be. And then they started looking for reasons why the value was so low. So one of the managers said, well, it's maybe because our growth rate is too low. Maybe we should reinvest more. So I said, okay, I'll reinvest more. I increased the reinvestment rate from 60% to 80%. What do you think happened to the value per share? Anybody want to guess? I use an 80% reinvestment rate here. What's going to happen to the value per share? Their growth rate goes up, right? With an 80% reinvestment rate. But what's going to happen? Chen, you want to try? What will happen to the value per share?
It would depend on their existing cost of equity. It would decrease their price.
It will decrease, and the reason is because they're taking projects that earn less than the cost of capital. So when I made it 80, the value went down to $50 rupees per share. They said, what if we reinvested 100%? I said, I'll go along if you want. It dropped to 40. It took them a while to figure out that reinvesting more and growing faster was not the answer. So they asked me, what should we do? So give them the advice. What do they need to fix? It's not reinvesting more. It's not growing faster. They need to reinvest better, right? They need to earn a higher return on capital. Part of the problem they were facing is their existing investments were actually tied up. There was no way they could increase the return on capital. So here's the first question asked. What if we could make a higher return on capital on your newer projects? And optimally, I'd like them to make at least 16.9%. Let's say that's asking for too much. If they can earn 12.2%, continuing to reinvest or at least 60%, then their value starts to go up, right? So 12%. If I make that return on capital even higher and I make them invest, if they can improve their return on capital, their value per share will start climbing. So here's where the corporate governance question comes in. Remember my original valuation, I got like 64 rupees per share. If I were an investor in Tube Investments, I'd have said, look, I'm going to pay only 64. Why? Because I have zero chance of replacing this family running the company. They seem to be in denial. They seem to be unaware of the fact that they even have a problem. And because they're unaware of the fact and I can't change it, I'm going to leave the value at what it is. If they show signs of listening and improve their return capital, then I'll pay more. And if they can fix some of the problems they have in their existing investments, I'll pay even more. So my point about you're already building in management qualities into your valuation shows up in the numbers you use in your company. So if you have a company where you have high returns on capital and you continue to keep it high, you're making an implicit assumption that management in place is good and will continue to be good. There are implicit corporate governance assumptions they can take that are essentially that are built into your valuation. Be careful about arbitrarily attaching a premium or a discount to that value. So when you value a company, remember you're already making assumptions about management. Be explicit about those assumptions. Any questions? Chen, go ahead.
Yeah, so I was wondering, most of their reinvestment went to working capital, and does that change anything if most of their investment actually goes to CapEx?
Well, it might give them an indication as to maybe one way they can improve their return on capital is by managing inventory better. So the way you go to improve your invested capital will depend on what kind of company you are. If you have a lot of manufacturing facilities, then it means building less factories. If you have a lot of inventory, it might be managing inventory better. So at least it'll give them an indication as to where can you go to improve your return on capital.
Okay, got it.
Carolina, you mentioned riskier projects. I'm not sure that will help them because that'll make their cost to capital even higher, right? So they have to take better projects, not riskier projects. So that's why the return on capital is the key variable, not the beta, the cost of capital. Anthony, go ahead. Question, Anthony, your mic is live.
No, my bad, sorry.
Okay. I just want to make sure I wasn't skipping over a question. So no questions. Let's move on to the last lesson I want to bring home with emerging market companies. With emerging market companies, though it's not just emerging market companies. Remember we talked about cross holdings, minority interests. It's what gave you headaches on the second quiz, if at all. I said you have to worry about cross holdings, and it's difficult to deal with cross holdings. And emerging market companies are particularly exposed to cross holding culture. Part of the reason is their history. Many of the largest emerging market companies used to be privately owned family group companies, and now they're public companies, and their history and the family ownership shows up as cross holdings. So with emerging market companies, often your job really begins after you think you're done. You know what I mean by that? You take free cash flow, you discount back at the cost of capital, you're patting yourself on the back saying, job well done, and then I hit you with all the cross holdings. Your job really begins in valuing those cross holdings. So I told you that, I was going to use Tata Motors as my example. I know it's impossible to read this page, don't even try. So I'll summarize what I did in this page. This was in April of 2010. I valued 4 Tata companies: Tata Chemicals, Tata Motors, Tata Steel, and Tata Consulting Services, all part of the same family group. They're 4 independent publicly traded companies. But here's what made the companies different. With each company, I did free cash flow to the firm, cost of capital, growth rate, all the conventional things. But notice after I valued the operating assets, there's other NO. You're saying, what the heck is that? Those are the cross holdings you have in each company. In the case of Tata Chemicals, their operating assets are worth about 57 billion, but their cross holdings are worth almost as much as their as their operating assets. Tata Motors, 231 for Tata Motors, cross holdings of 141 billion. Tata Steel, 502 billion, cross holdings of 467 billion. Tata Consulting Services, though, operating assets are 1,365, cross holdings are much smaller. So if I showed this to you as a graph, here's what it looks. Almost 50% of Tata Chemicals and Tata Steel's value as companies comes from their cross holdings, which is a dangerous place to be because remember, those cross holdings are in companies you really don't know much about. Tata Motors, it's about 37%. But Tata Consulting Services, it's only 4.6%. I know it's unfair if you've never heard of these companies, but I'm going to ask a question that somebody who has some familiarity with these companies should be able to answer. Why is the cross-holding such a small percentage of Tata Consulting Services and such a big percentage of Tata Chemicals, Tata Steel, and Tata Motors? Anybody want to give it a try? Why is such a high percentage coming from cross-holdings for Tata Motors, Tata Steel, and Tata Chemicals? Ayan Ali Shah says they're older. That's exactly right. But can you unmute yourself, or are you? Come on live and tell us why being older drives this. Because you're right. It is the fact that they're older. Tell me why being older has an effect. Go ahead.
Tata Steel, if I'm not wrong, was started originally, and they would have started as, and then they would have had shareholding in TCS versus. I'm not entirely sure.
Okay, so let's go back in the history. You go back 35 years. All of these companies were privately owned. None of them was publicly traded. They were all privately owned by the Tata family, right? So let's say that one of these companies, Tata Motors, wanted to build a new plant and it didn't have the money. You know what the family did? They went into Tata Steel, it had a good year, took money out of Tata Steel and put into Tata Motors. It was all completely legal because they owned all these companies. And then they would give Tata Steel shares in Tata Motors because they moved the money from Tata Steels to Tata Motors. So you see why being older matters? The longer you've been part of the family group, the more you've been affected by these cross-company investments. TCS is the youngest company in the group. It's been around only 20 years. Most of its life, it's been a public company. It's more like 30 years. It's not had a chance to do all this cross-company stuff that the other companies have. So the age of these companies really explains why they have so many cross-holdings. It's not a conspiracy that they are out to get you. It just reflects their history as a company. So if you have family group companies, whether it's a Samsung group or whether it's one of the Japanese companies, the older the company, the more you have to worry about this cross-holding effect, because the more it reflects the history of that company. Okay? Any questions? Now if you have cross-holdings, what do we say you should do? Optimally, what would you like to do? Value each holding separately, starting from the base, doing a full-fledged. Remember the example we did with Yahoo? That's going to be almost impossible to do with these companies. So that's why I suggested that shortcut, which is you have the book value of these holdings, try to at least convert them to market value by using the price to book ratios. So it's a reality you have to face. You can't run away from it. You can't be in denial. It is what it is. Deal with it the best you can and move on. Any questions about any of the issues with emerging market companies? Because I know some of you are valuing emerging market companies. Carolina, you said, is it because they're funded with equity? Kind of, because in those days there wasn't even equity. It was just earnings from profitable companies within the group being used to fund investments, but earnings are equity money, so technically you're right, it is equity.
I have a question.
Yeah.
If some of these cross holdings are not publicly traded, should we just use the book value?
Yeah. Do as I said. No, even if they're not publicly traded, you can still use that price to book ratio. If you know what sector, let's say you have a private holding in a chemical company, and chemical companies typically trade at 1.5 times book value. You can take the book value and multiply by 1.5. Right?
Will we get the ratio from other companies?
Yeah, other publicly traded. So go to my website. I have price to book ratios by sector under data. Okay. So you can apply that to the holding. Now let's talk about the final issue. And this is not just specific to emerging market companies because this crisis is... Yeah, go ahead.
I got a question. How do you come up with the pricing book ratio?
Of what?
The pricing book ratio of the
Well, you don't have to come up with it. If it's publicly traded, there's a market value and there's a book value.
Okay.
So you divide market by book. That's why you get it from looking at other public companies in the business, because there I can look up the market value.
Okay, thank you.
Now let's talk about the final issue. This is not specific just to emerging market companies, but when you do a valuation, we talked about this with distressed companies, you always worry about truncation risk. What's truncation risk? That your company might cease to exist. In the case of distress, it's because they could not make their debt payments. But with emerging market companies, your company can cease to exist for lots of different reasons. It can be a natural disaster, right? Your company is a hotel company, it's not fully insured, there's an earthquake or a hurricane, your company could get wiped out. It could be terrorism risk, where a bunch of terrorists come in, destroy a business, and there's your company. Or it can be nationalization risk, which is the government takes over your company and pays you well below market value. Now you say, what do I do about all of these? Do exactly what we did with distressed companies. Remember what we did there? We did a discounted cash flow valuation acting as if there was no such risk. And then once we were done with the discounted cash flow value, we asked a follow-up question. What's the chance of terrorism? What's the chance of nationalization? And what will I, as an equity investor, get as a consequence? So rather than talk in abstractions, I'm going to take you through a valuation I did fairly recently, last year, when Aramco went public. So remember, this was October, November of 2019. Aramco, overnight, the largest market cap company in the world, decides to go public. For those of you not familiar with Aramco, Aramco is all of Saudi Arabia's oil essentially incorporated in one company. So essentially it's 330 million barrels of oil, that's the company. And it's the oil that is closest to surface, the cheapest oil to extract. So they decided to go public. It's a very simple company to value. I actually valued it using a fairly unconventional route. What's the unconventional route? You know how we value companies, right? We project cash flows for 5-10 years. At the end of the 10th year, we stop, we estimate a terminal value. In the case of Aramco, I didn't do that. I just extracted oil until there was no oil left in the ground. And then I put a terminal value of 0. I said, what's left? So basically what I had was 50 years of cash flows, because that's how much oil is left in the ground. And I estimated the cash flows each year. In the case of Aramco, it's actually a very simple valuation, because a company is actually telegraphed what percentage of its earnings it's going to pay in dividends. In fact, guaranteed that its dividends next year, which will be 2020, will be 75 billion. And I've let those dividends grow at 1% a year for the next 50 years. So put simply, here's what I have. I have $75 billion growing at 1% a year for 50 years. That's my expected cash flow. Very simple valuation. I discounted back at a cost of equity that reflects the fact that it's an oil company. I did my entire valuation in US dollars. You're saying, why are you doing this? It's a Saudi company. It's an oil company. Oil companies around the world give you their cash flows in dollars, including Aramco. If you look at Aramco's prospectus, most of the numbers are in dollars. They're not in Saudi riyals. So basically, the risk-free rate that you see there is a US T-bond rate. The beta that I used was actually not a beta for oil companies, because the way Aramco is structured is the dividends are almost set as a percentage of earnings. It's almost guaranteed dividends. That makes it closer to a real estate investment trust or a royalty trust, where dividends are set upfront as a percent of income. So it's a very safe investment from an equity perspective. That's why the beta is so low. And the equity risk premium that I used was the equity risk premium for Saudi Arabia. Why? Because all the oil is in Saudi Arabia. Remember, we said for natural resource companies, your risk doesn't come from where you sell the oil, it's from where you get the oil. So the cost of equity that you see there looks really low, but that's because Aramco is more bond than stock with 50 years of cash flows. So I did the valuation. The value that I came up with was about 1.629 or 1.63 billion. You're saying, I'm done. Well, that is my dividend discount model value for Aramco. Now, you could actually argue that maybe I shouldn't be trusting dividends, I should be computing free cash flow equity. If you want me to do that, that's pretty simple to do. Here I've computed the free cash flow equity for Aramco instead of the dividends. I use a higher cost of equity to reflect the fact that free cash flow equity is more uncertain. So with dividends, I just looked at the guaranteed dividends, which were lower than my free cash flow equity and used a really low cost of equity. Here I'm looking at potential dividend, free cash flow equity, and discounting back at a higher rate. Here I use the oil company beta. And the value that I get is pretty similar. It's about 1.65 billion. So both my dividend discount model and my free cash flow equity model give me values of about 1.65 billion. Now let's say that you are thinking about buying Aramco shares. It is like any other oil company, right? Not quite. Because when you're buying Aramco, you're not buying a company, you're buying a country. What do I mean by that? 80% of Saudi Arabia's GDP comes from oil, and Aramco is in control of that oil. So you're buying a country. And then if you think further, it's not just any country, it's a country that's run by a ruling family. You're essentially making a bet on the House of Saud continuing to run Saudi Arabia. That's a loaded bet. Talk about a politically incorrect investment. You're investing in oil, you're investing in Saudi Arabia, you're investing in the House of Saud. And here's what you need to worry about. What if something happens to the House of Saud? All these cash flows could dissipate, right? Remember Egypt in 2008, essentially you woke up one day and Mubarak, who had been was supposedly dictator for life, was gone. What if that happens in Saudi Arabia? So in the case of Saudi with Aramco, here was my concern. This is the value that I get. 1.65 billion is the value that I get assuming no regime change. But what if there is a regime change? I'm not a political scientist. I'm not claiming there will be, but I think assuming it's going to be zero is being unrealistic. For the next 50 years, you think nothing will happen in Saudi Arabia? Let's assume there is a non-trivial chance that there could be a regime change. Let's say there's a 20% chance. The question you've got to ask yourself is, what will my equity be worth? The limiting example for this is you can say, well, ISIS takes over Saudi Arabia, my equity is going to go to zero. Now, if that's your version of a regime change, then of course you should put a value of 0 to the 20% property. I don't think that's going to happen. I think there's a regime change in Saudi Arabia. That regime that comes in will not be as friendly as the House of Saud towards Aramco, but it doesn't want to kill the goose that lays the golden eggs. So they might reduce the dividend, maybe pay out less in cash flow. So what I've done here is value the equity twice. Assuming the House of Saud stays in place and there's a very smooth transition of power, the value is 1.65 trillion. There's an 80% chance. But assuming there is a regime change, I think my value is going to be half 1.65 trillion, 0.825 trillion. And my expected value then is 80% times 1.65 trillion plus 20% times 0.825 gives me a value of 1.49 trillion. Again, I'm using exactly the same technique I used for Las Vegas Sands. But here the risk I'm worried about is not distress risk or the failure to make debt payments. It's a likelihood of a regime change. You didn't think you could bring in political risk into DCF? Think again. You can. And you can make this much more sophisticated if you want. So you can think about ways in which you can estimate likelihood of regime change. But I think it's assuming it away or acting like it's not there doesn't make it go away. Trying to bring it into the discount rate is not going to work. This is, I think, the most effective way to bring in the probability of truncation risk. So if you're valuing a company in a risky part of the Middle East, a Lebanese company, and you're worried about terrorism risk, the best way to bring it in is through this. You're valuing a Latin American company in Honduras or Venezuela, and you're worried about the probability of nationalization. The best way to bring it in is by bringing it in with the same approach. So use this as a tool in your toolkit whenever you face what I call discrete risk, where there's a likelihood of change and you want to bring it in separately into your valuation. So I'm going to pause and let you ask any questions you might have on this, because I think it's a very useful tool to have, and I want to make sure you understand exactly what I did with Aramco. Any questions? Go ahead, Ray.
Professor, if there's a regime change, should it already be priced into the Saudi countries?
It might be. So we're not talking about price, we're talking about value, right? So ultimately the price at which the company might go public will reflect that likelihood. But when you're doing the value, it's not anywhere, right? You're doing the cash flows. It's your job then to bring it in explicitly, otherwise it's not going to be there.
Understood.
So the pricing might already reflect it, but no. Salma, you're on. Go ahead.
So in this this example, how did you estimate the value after a regime change?
Well, it has to. When you talk about regime change, you also have to make an assumption about what kind of regime will replace the existing one. That's why I said if you think that it's going to be ISIS running Saudi Arabia, what's your value going to be?
Of course, like way less.
Yeah, it's probably going to be zero. I mean, way less, I think, would be a kind way of explaining it. So I think that when you bring in political risk, then you have to fill in the details, right? So if you're valuing an Egyptian company and you're going to bring in likelihood of changes, you've got to kind of fill in the details and say, this is what I think the new regime will look like. And you can cut the other way too. Let's say you're valuing a Venezuelan company now and you think Maduro is towards the end of his tenure and you think a much more business-friendly regime is going to come in, the value might attach to a Venezuelan company on the verge of a good regime change. Because regime changes don't always have to be towards the worst. They can be better. Your value could be higher with the new regime in place, but you have to fill in the details on what that regime will look like.
Okay.
Chloe, you're saying, where does the 20% come from? Yeah, it's got to be a judgment call, right? So if you have any good political science friends, you might ask them. Most of them are useless if you ask me. But I think there are political risk services who try to estimate, these things. But I think that there's no source particularly you can try. Ultimately, I read up as much as I could. You have to look at history. You know what, that 20%, 20 years ago for Saudi Arabia, that number was probably close to 0%. You know what's changed in the last 12 years? You had Libya, you had Egypt, you've had regimes that we thought where the ruling regime was so... we thought that Gaddafi would run Libya till he died and that, the same thing would happen in Egypt. And we've learned that regimes are not as solid as we thought they were. So this is a shifting target and you got to do that. Jorge asked, can you run sensitivity analysis? You can run what-if analyses and all of that, but ultimately you have to make a decision, right? Buy or sell. So what will the sensitivity analysis give you? Just a range on the values. I've basically found very little to gain from doing what-if analysis. You can do simulations. I think that's more useful. But running what-if, it's not going to help you that much. Ray, you have another question or your hands up from before?
Nope.
Okay. Any other questions? I'm going to stop there because it's been a long day for most of you. You've had the quiz, you've had other stuff. So thank you for coming into the session. I know it's been a long day and this adds on to it. So I will talk to you on Wednesday. So if there are no other questions, I'm going to sign off and keep sending me your DCFs. Your question? Go ahead.
So would you mainly use this kind of probability of a regime change only in more hostile situations? So
Yeah.
Not in the case of Bernie Sanders becoming president of the US situation?
That's actually a good question. Now, you know where I'd have used a regime change in the US? For a healthcare company. Right? Because for a healthcare company. Because there you have... See, anytime you have a discrete outcome, Medicare for all is a drastic shift in the way healthcare is funded and created in the US. So for healthcare companies, I'd have a Sanders valuation and a Trump valuation and have to estimate probabilities of winning and losing. So, maybe I was saved from that fate. But it's not just reserved for emerging markets. It could be any time you have a regulatory change that's going to come out of an election, you might want to do this. It's a discrete risk. Any questions on your projects that you're working on there? Because as I said, I've been trying to get these projects back. I've had a bunch that came in today. So if you sent it in today, you might not have got it back, but you should be starting to get it back by tomorrow. I'm going to start. I should be caught up with those DCFs, but keep sending them in. Now I know that there was a deadline of Friday, but it's really not a deadline because I know that your lives are in transition, you're traveling, you have logistical issues. So whenever you get done, get it into me. I'd like to get most of them in by Friday because otherwise they're going to stagger in. So whenever you get done with your DCF, send it in for feedback. As I said, it's not for grading. I'm not going to be brutal. I'm not going to tell you the revenue growth is wrong. I'm just going to check it out, make sure that there's not something that you might want to think about. So most of the time when you get feedback, it's not going to be fix that number, it's wrong. It's, do you really mean to do that? Is that the story you're telling for your company? And hopefully that might help you kind of finesse the DCF. It's your feedback loop.
Professor, I had a question.
Go ahead.
I noticed my company applied the IFRS 16 to the leases.
Yeah.
And I didn't quite understand the effects.
Basically what it means is remember how we converted operating leases to debt in class?
Yeah.
IFRS 16, accountants have already done that to operating leases. So when you've had IFRS 16, you have two choices. You can take the accounting lease debt and not do leases yourself, right? Basically say, I trust the accountants, they've already done it for me, I'm going to treat that as debt. So if you do that, say no to the operating lease question because the accountants have done it for you. Or you can say, I don't trust the accountants and ignore the debt and do it yourself by taking the present value of lease commitments. That's all that IFRS 16 does, is the accountants have capitalized the leases and essentially set it up for you.
Oh, okay. Thank you.
Any other questions?
Hi, Professor. I have a question actually.
Go ahead.
I'm doing Boeing, and the thing is that I've actually read a lot about this company, and one of the things this company did was that a couple of years ago they invested in a factory in India, and they invested, they sort of like offset a couple of engineers to there, and because of that, there are inconsistencies while producing 737 MAX. And apart from producing the 737 MAX in there, they produced a couple of other airplanes like HAP in there as well. And
yeah.
For example, like 1/4 of the 787 Dreamliners can have actually a faulty oxygen system. And I have a question where I should account for that.
What do you think? If you believe these stories, should you?
Well, probably I should.
Absolutely. I think you answered your question. The question is, are these credible stories? Because if it is true, then the 737 MAX problem that almost killed them last year is going to keep reoccurring in future years, right? I don't know whether that's true. So that's really the question, is check for the credibility, because I haven't read anything about the 787s being flawed, and we haven't had any issues with 787 so far.
There was one issue with the lithium batteries.
Yeah, but none of them, some of those are just growing pains. Every new aircraft, whether it's from Airbus or Boeing, the first 2 or 3 years of that aircraft, or maybe even the first 5 years, you have a ton of small issues that come up. When the Dreamliners first came out, there were issues with the windows and the air conditioning and all that's the heating. All the stuff that you. This is an incredibly sophisticated piece of equipment to be up 36,000 feet in the sky, to be safe and be carrying 300 people. So some of that is part of growing pains that everybody has. So I'd say don't overreact to these stories, because some of them I think are just make it look like Boeing is exposed to all this. I think with the 737 MAX, their problem was they trusted the robots and the computers too much. And it's not that the equipment was damaged. They assumed that if they built it in, if they put things on autopilot, that they would avoid mistakes. But in the process, they created a set of new mistakes that people were making in terms of using that equipment. So I think it was less an equipment malfunction problem as it was a problem of assuming that people in computers would interact in the right way. So I wouldn't overreact, but I think I would factor it in to my valuation, and it is factored in. I think Boeing's been punished for the 737 MAX more than proportionately, and you have to decide whether the punishment meted out is enough or too much.
Thank you, Professor.
You're welcome. No other questions, folks?
Professor, may I ask whether we should convert other commitments other than operating leases, such as licensing and other things?
It depends on how rigid the commitments are, and that's actually very tough to back out of the financials. So I'm a little reluctant to add on other commitments until I know more about them. So for Disney, for instance, there are broadcasting commitments that I don't include as debt because I know their broadcasting commitments are pretty flexible. ESPN has broadcasting commitments on sports. But to the degree that if there's no Super Bowl next year, they don't have to pay that commitment. So there is enough flexibility, then you shouldn't treat it as debt. So my suggestion is, unless there's something to indicate that it's a deep contractual commitment, don't count it as debt.
Okay, thank you, Professor.
Tim, go ahead.
Yes, sorry, I don't want to keep you for too long, but I'm evaluating Daimler for my IPCF, and I wanted to ask you a question about how you dealt with Volkswagen and your evaluation.
Yeah.
So I don't want to name names, but the bank where I worked for this summer, they told me that for all these German car makers, you should not include the financial services branch in your evaluation. Now, first of all, is that true? Or would you agree with that statement? And second of all, Daimler recently renamed their financial services department and turned it into their mobility department, and I think that's a very exciting branch of development for them.
I'll tell you why you don't want to include the capital. It'll create all kinds of numbers issues for you. Because, for instance, if you take Fiat and you include Fiat capital, their debt ratio becomes 85%. Your cost of capital collapses. All kinds of weird things happen. So you keep the financial services arm separate, not just for German companies, but for any automobile company, because if you bring it into the valuation, it kind of makes everything go haywire. When you do that, though, you are implicitly assuming that the financial services business is kind of a neutral business, and it's a captive business. In many of these cases, the financial services business, whether it's GM Capital or Volkswagen Capital, the only business they have is financing customers buying the company's cars. So the numbers really don't mean much, because if the company says give customers a discount, let them borrow at a low rate, the capital arm has to do it. So you're assuming implicitly that the capital arm neither creates value nor destroys value, which is not a terrible assumption to make unless you have a capital arm that's gone crazy, that's given auto loans to people who will never pay you back. So it's true, when you do a discounted cash flow valuation of an automobile company, you don't want to bring in the capital arm, but check out what the capital arm is doing to make sure it's not something that's going to get you into trouble. In the case of Daimler, they've been very clever in renaming the arm and giving it a mobility front, because they're hoping that you will look at an Uber and say, you know what, Daimler Mobility, let's attach.
That's exactly what it's considering is this would be an exciting part to compare it maybe to Uber and Lyft. And
I don't think it's going to work as long as it's part of Daimler.
And bring the value up.
Yeah. It's a pricing game. They're playing the pricing game.
Okay.
Right? Okay. So I wouldn't get too excited about it, because until they actually do it, it's just a name.
Okay. So maybe ignore it.
I would ignore it for the moment. And maybe if you want to make it part of your story, of mobility services and maybe what they can get out of it, because it's one of the few optimistic parts of the story left for Daimler, right?
Okay, great. Thanks so much.
You're welcome.
So just following up on that question,
yeah.
When we read the debt of the company, we take out the portion from the financial arm.
Yeah, I would. Otherwise, you're going to get a real mess when you do the valuation. But there should be but make sure when you add back cash and marketable securities, that you're not adding something that the financial arm carries, because you want to kind of neutralize it, right? You take out that debt, you also should be taking out the counter assets that have been created, because some of your securities that you hold on the asset side are really securities to back up that capital arm.
Oh yeah, that's right.
Yeah. Just make sure you're not you're not ignoring the debt, but counting in the good stuff.
And do we need to make other adjustments other than that?
No, that's it. Just leave it be and hope and pray that it doesn't come back to bite you.
Okay. All right. Thank you.
Okay, that's it. And I think we're done for the day. Are there any other questions before I sign off?
Professor?
Yes.
So in your Boeing evaluation, you mentioned bailouts as a potential to wipe out equity, as in the GM's case. Can you elaborate on that?
I'm sorry, the Boeing valuation, can you repeat that?
You mentioned that bailouts
can
potentially wipe out equities.
Yeah, because when a government gives a bailout, it asks for something in return, right? So in the case of in 2009, when the US government bailed out GM survived as a company, but in return for the bailout, GM wiped out the equity in the company. So when GM came back as a public company in 2013, the original stockholders in GM got nothing. So one of the things you have to watch out for in bailout is in return for the bailout, are the equity investors being asked to do something? They might be asked to take nothing. They will say, go away, you're done. They might in some case be restricted in the form of dividends and buybacks, which is, I think, going to happen with this bailout. Or the government itself might take a share of your equity, in which case the number of shares outstanding is going to increase by the percentage that now has to be given to the government. Do you see what that's going to do, right? The number of shares you think is 100, but the government says, okay, in return for the bailout, we want a 50% stake of the equity. That basically means your share count will have to go from 100 to 200. So that's why I said you have to be explicit about what the bailout terms are. And I think for the moment, at least, it looks like at least on this bailout that they're talking about for Boeing, there's no required quid pro quo, so the equity investors are okay.
Okay, understood. Thanks for the question.
Okay. Okay, so that's it for the day, and I will talk to you on Wednesday. Take care and have a good day.
Thank you.
Take care. Bye-bye.